Tom, it's been a good call so far, your bullishness, especially when you were sort of out on a limb and everybody was so bearish. But now that a lot of investors have caught up with you and we've seen sentiment turn as momentum higher continues here, are you still feeling as bullish?
Yeah, in short, Sarah, yes. I think most of our clients think this is just a bear market rally that will fail and we're going to retest the lows. And in fact, there's quite a number who have been sitting out this rally, waiting to short because they think we could move towards 3,000. So I think there is a bias right now for investors to think we're in the early cycle of a recession, markets making new low. I think the signaling coming from equities, especially sector leadership, is arguing that this is proving to be maybe a growth scare. And as the inflation data weakens and economic data softens, that actually makes the Fed's job easier. And then I think in the second half, we're going to get quite a lot of PE expansion and better earnings. So that's why I think all-time highs is possible.
But already we've added, what, 3 points to PE? We're around 18 right now, the price to earnings multiple just in the last few weeks?
Yes, that's right. I think what investors have to ask themselves is if their view is correct and we have an inflation problem, why is the 10-year at 2.75%? Because that's a 37 PE for a 10-year bond with no upside and losing you money owning it. And if the 10-year is anchored correctly, I think the S&P PE is going to drift back towards 20 to 25 times. And at 20 times, you get towards S&P 5,000. So I think that the burden is on the market to prove that the 10-year has to move towards 4 or 5% before they can be bearish on equities.
Well, there are bearish investors, Tom, who say that the bond market has become too dovish here and that it's ignoring what it's hearing from the Fed, which all the messages from even the most dovish Fed members are that we still have work to do on inflation.
That's right. I mean, that's a great point. There's a divergence between what the Fed is saying and wants and what the bond market's doing. But as Volcker says, if he could be reborn, he'd want to be born as the bond market, because the bond market really tends to signal where the Fed should go. I think you've heard that from a lot of your fixed income and macro investors, that the bond market is telling us the Fed might be done sooner than they realize. And again, whether you're looking at the 10-year or the 2-year, it's telling us inflation's not as sticky as people perceive it to be.
Another argument that I hear from some of the folks that you say are a majority of your clients that think we're going to retest the lows is that we've almost become complacent about the bad news. Look what happened this morning. We got a sharp drop in New York Empire manufacturing. The Chinese data was really weak, and the market did not get any comfort from the rate cut that we got out of China. The increasing recession risk, just the idea that we've become complacent. The VIX going below 20. And that is actually not a good thing.
I mean, these are certainly signs of complacency, but they're also signs that investors are positioned for far worse. I mean, as you know, this is bad data on an absolute basis, but this is maybe not surprising markets. I just think too many folks think we're heading for stagflation or years of inflation or depression. That's what we hear from even our most fundamentally focused clients. They just have a lot of fear and lack of visibility. I just think the market's reaction to all this bad data is really the signal.